everyone, Coach Mike here. Today we're going to go over some key terms that you want to make sure we know that you'll hear all the time when talking about IBC, infinite banking. These terms will be important to remember, understand, and help us along the way learning. First set of words I'd like to go over are the players, as Nelson would call it, regarding a policy. We've got the owner, insured, and the beneficiary. The owner is probably the most important, or certainly the one in control of a policy. The owner is the one who would apply for the policy and have the right to pay for the premiums and as well to take the loans and borrow against and repay the loans, just as importantly. The owner has control and can decide who the beneficiaries are. The insured, okay, this person oftentimes is going to be the same person as the owner, right? If you open a policy on someone's life, that person's life would be the insured, okay? And oftentimes, if I opened a policy on my life, got a policy for myself, I am the owner and the insured. So the insured plays the role as far as the person upon who, policy is based. That's for the age, the health rating, and all that. So that would be the insured person. And then the beneficiary, okay, is the person that benefits from the policy as far as the death benefit goes. Okay, the proceeds at the passing of the insured would flow to the beneficiary. And the owner would decide, who that is, if it's one person or multiple people, if it's children. It could be, spread out evenly as far as the amount of the benefit. It could even be an institution, like a church or a university, something like that. So that's the beneficiary. That death benefit would flow, tax-free to them. Next, death benefit. Let's talk about that. The death benefit is the total amount of cash money that would flow to, the beneficiary upon the passing of the insured person. Okay, that's the death benefit. So we talk about death benefit in terms of dollar amounts, right? It could be, maybe a $10,000 policy all the way up to millions of dollars. When they talk about a $1 million policy, typically they're talking about the death benefit, what it's worth at the end of the insured's life. Now, important piece to this is the cash value. Cash value is going to be only available for whole life policies, right? Because all insurance policies, term or whole life, have death benefits. Only whole life have this second term of cash value. Okay, so what is cash value? Cash value is the equity in the policy. That's one way to think of it. It's literally the fraction of the death benefit that is building up and allowed for the owner to borrow against. Okay, so let me explain a little bit about that relationship of cash value and death benefit. Cash value is another term, surrender value. They go hand in hand. The surrender value of a policy is going to be the cash value for most, intents and purposes. Surrender value, cash value is how much that policy is worth today if that person, the owner, were to surrender the policy, give it back. This is how much that death benefit in today dollars is worth to them. So that's the same as the cash value. And that value is what you can borrow against, all the way up to whatever that cash value amount is in a whole life IBC style policy. Great. So what drives the death benefit and the cash value, right? Obviously, we have this term premiums, right? Whether you pay, and a premium is simply the amount of money on a regular basis that your end of the bargain is to pay for the policy. Premium can be paid annually, monthly, and anywhere in between typically. Okay. But the premium, okay, pays for that death benefit. And as long as you stick with it, the policy, is in force and continues to grow. Let's break down the premium for an IBC policy. There's two types of premium. The first is the base premium. Base premium is the backbone of the policy. This is the contractual amount that you need to make sure to pay each cycle or each year, if you want, or month, in order to keep that policy in force and continuing to grow. Okay. Its main job is to provide that death benefit early on from day one and throughout the life of the policy. The other critical piece for IBC policies is the PUA. Okay. This stands for paid up additions. Additional what? Additional death benefit or protection, right? Literally, the PUA dollars, in addition to the base, comprise the amount of the annual premium that we pay into an IBC policy early on in order to get it capitalized. So PUA stands for the paid up additions. If you recall my space shuttle analogy, the PUA dollars, in addition to the base, form that shuttle where the base premium is the shuttle and the PUA dollars are the boosters. So PUA dollars are important early on while we're capitalizing the policy, and we'll talk about that word soon, to get the policy front loaded with cash value that we can start using right away and leveraging to finance our lives, our investments, anything. Okay, so that's the paid up addition PUA. Next, let's talk about the dividend. Okay, dividend, right? Generally speaking, a dividend is profit that a company would share and pay out to its owners. Now, it's a little bit different, but the term dividend applies, or is used all the time for IBC policies too. These companies are mutual companies and pay these dividends each year. And as an owner of a policy, you'll earn a dividend each year, right? They're not guaranteed, but they have been paying for a long time, over a century in most cases, right? Straight. So this is a consistent benefit that is paid out to the policy holders to further buy you what? With IBC policies, the dividends are not just taken as cash, but the dividends are used to buy us additional PUA. So this is essentially converted to PUA that you don't have to contribute. This is like the policy building upon itself and compounding through the dividend purchase of additional paid up death benefit. Now, dividends, by the way, are also tax-free, okay, which is different than with public companies because the dividends are really just a return of premium. The way it works, it's more complicated. No need to get into it. But just remember, dividends flow to us each year on a tax-free basis, especially when, building up additional PUA. Now, let's talk about this term, insurability. Insurability. Okay, what does that mean? So generally, you want to look at the insurability of a person as far as, well, A, is this person insurable? Think about it there. There's two kind of definitions to this, the way I think of it. If a person is, of a certain age, young enough, healthy enough, and can pass the screenings or underwriting, which we'll mention too, then they're insurable. They can open a policy on themselves. Now, another meaning of insurability may extend when you have a different person that wants to open a policy on someone else. Okay. In this case, you need insurability on that person. That means there's an insurable interest or a relationship, specific type of close relationship that exists between the owner who wants to open a policy on person B. Okay. The easiest example would be maybe a spouse, a married couple where spouse A wants to open a policy on spouse B for their lives. They obviously have an interest in each other's survival and well-being. So that makes sense. Another example would be parents opening policies on their children. So the parent would be the owner, the child or children would be the beneficiary or the insured. Okay. And there's no problem there. Again, the relationship is close enough. It makes sense that obviously the family wants, each member to be protected, betterment of the family. I talk about a close enough relationship where on the other side of things, you wouldn't necessarily have an insurable interest on somebody who is a stranger to you, right? If you see, Joe Blow on the street, they look healthy. I'm not. They're much younger. Hey, Joe Blow, let me talk to you and get a policy on you because you're young and cheap, as far as that goes, and I'll pay for it and benefit from all the control I get and the banking functions on your life because you're, healthy and I'm not insurable. Well, that's not going to pass muster, right? Insurability is, there's no evidence of insurability between those two parties. There's no familial relationship. Essentially, historically speaking, they've had, issues or examples where, hey, you buy this policy on someone and who's to say I don't, have a hitman come and take them out, take all that benefit, death benefit. So of course, that's kind of like out of a crime novel. But so yeah, insurable interest is important. Now, underwriting. Okay, maybe you've heard of this term. Underwriting. This describes the process through which the insurance company is going to take a, fine-tooth comb, and as you open the application, they will look through the insured's records, medical records, and offer a test, an exam, medical exam to make sure that the insured applicant or the, is insurable. They're healthy enough, to have a policy approved for them. So underwriting is simply the process of their investigation to make sure that the insured is fit for a policy, and they'll price it accordingly by their health rating or MEC limit. Okay, this is a word that stands for Modified Endowment Contract, MEC, Modified Endowment Contract. So simply put, the MEC limit restricts how much premium can be paid into a policy in the first early years while in order to maintain its tax-free status as a vehicle of growth over time. Okay, modified endowment contract is simply legal term, financial term that the IRS has deemed any policy to be in case you've overfunded it. You've gone too close. You stuffed in too much premium, too much cash value would be, relative to the death benefit. So the MEC limit is, in another sense, how much cash value can you have in a policy relative to the death benefit at a given point in time, typically early on in the policy. So there's a corridor, they call it, between cash value and death benefit that is okay, but up to a certain point only. And beyond that certain point, if you overfund it too aggressively, AKA throw in too much PUA, you risk MECing the policy is what you'll often hear it being called, or the policy becomes flagged as a modified endowment contract. And the government, the IRS, then decides, hey, you went too far on this, and we're going to pull that advantage of the tax-free growth. And now all of a sudden your policy will become a taxable vehicle. No good in our opinion. And it's something that we work, to avoid. All right. Capitalization. You've heard of this term. When we talk about capitalizing a policy, essentially the way I look at it is that's when you are not just funding the policy with the base premiums every year over time, certainly, but even overfunding it with that PUA. That strategy of overfunded base premium plus PUA is what I consider capitalizing your policy, especially those early years, maybe 4 or 5 years or so, to get that cash value jump started and compounding sooner than later. Okay. All right. Velocity banking. Okay. This is a popular term, and we call it on the inside turning the wind current. Nelson talks about it, right? You turn that wind current. Velocity banking. What is that? So this is where you're using a simple interest line of credit. Okay. The perfect example, best example would be an IBC policy through the cash values. And then you're essentially sweeping, out that equity from the cash value loan to pay off or pay down the consumer debt. Okay, that is velocity banking. And as each debt, consumer debt is paid off, okay, it's swept in or, to the simple interest policy loan as a policy loan. You might exchange $10,000 of policy loan capital to pay off 2 credit cards, 5,000 each, let's say. Each credit card is now paid off, but each credit card was draining you by $400 a month. Now that $10,000 results in $400 times 2, $800 of freed up money that we've turned the wind current on. Instead of that money flowing out every month, to Bank of America or Chase or whoever the credit card banks are, that $400 is redirected right? That's why we redirect that current towards our policy loan. Now we're repaying ourselves that $800 to repay that policy loan with. We're recapturing that interest in that way. So that's velocity banking, or turning those wind currents. All right. And the last thing, maybe you've heard inside or outside debt we talk about. And here it is, the inside debt would be that debt that you swept internally, you kind of absorbed on your side to your benefit, where the interest you continue to pay now benefits you. The outside debt is any of that amortized or consumer debt, the more expensive stuff that, all the interest, no matter how low the rate, is flowing out of your system every month. Okay, so that's outside debt. We want outside debt to be inside debt. And in so doing, that is turning the wind current. That is what the velocity banking is. So we've gone through a lot of terms. Hopefully this was helpful. Tune in next time for more tips, tricks, and information about IBC, DIBS, income stacking. Thanks.